Hello everyone, nice to see you. And today we will continue our lectures. Please write me in the chat. Can you see me? Can you hear me? Is everything okay? Can you see my slide? Can you see my screen? So, could you? Yes, we can. Thank you very much. Okay, let me start. And today we will continue our theme financial performance management, and our last lecture was dedicated financial performance management, modern trends and important implications. And we have discussed the role of managerial accounting, the trends in financial performance management. We have discussed activity-based cost management in comparison with standard costing. Then we have touched a little bit a topic dedicated to the lean management. And you have watched the video about the practice of performance management dedicated to the managerial cost management. And today we will start topic dedicated to evaluating financial performance. And our questions for today's lecture: concept and principles, main users of financial performance evaluation, financial result by areas of activity and groups of users. Then we are going to discuss the role of performance analysis, techniques and methods. We are going to discuss also corporate value creation and its measurement. And then our next topic is about ratio analysis and its application. So these are our questions for this block, evaluating financial performance. And today, I think we will discuss these topics: concept, principles, users, financial results, role of performance analysis, techniques and methods, and corporate value creation. And in the end of our lecture, you will watch the video for reflection. This video will be about the comparison of the shareholder value creation and stakeholder value creation. And the part of our lecture will be dedicated to this discursive topic. Okay, in order to start our lecture today, please write me in the chat your ideas. In what ways, in what spheres, in what cases do we use financial performance evaluation? For what purposes? Maybe you have experienced and you applied in your practice and your professional life, maybe in your studying financial performance analysis, financial performance evaluation, and for what purposes did you do it? Maybe you have some ideas, maybe you have experience, and please write me in the chat in order to start our discussion. Maybe you have read special literature about this topic. Mhm. Okay, so while you're thinking, I'm opening. I've opened. Next slide. It's about the main principles of financial performance evaluation or financial analysis, and you can see the main purposes of financial performance evaluation. So we can use financial performance evaluation or financial analysis in different spheres for different purpose. For example, for evaluation of current and future perspective of our business. We can evaluate business models of our company, future business models of our company, or current business models of our company. Then we can use financial performance techniques, financial performance evaluation for clarifying the available sources of finance and the assessment of their possibilities, usefulness. And our next slide is about the uses of financial performance evaluation. And you can see that there are a group of stakeholders or group of interest. So group of interested stakeholders. So owners, investors, or stockholders, investors, stockholders, enterprise management, employees, suppliers, customers, government can be interested in results of financial performance evaluation and in the results of financial performance analysis. And these different groups of stakeholders can use the financial performance evaluation for different purposes. For example, government. If we are talking about, for example, public-private partnership projects, of course, government plays the role of stakeholders in these projects, and of course, the government will be interested in the result of these investment projects. And the result in the form of taxes, for example, or some public services. If we are talking about employees, of course, the main interest of employees is to get salary in time, to have some social guarantees, and of course, we as employees are interested in sustainability of our employer. And sometimes, of course, we can be interested in looking at financial reports to get some information about the sustainability of our employer. If we're talking about the owners, mostly they are interested in capitalization of the business, and the concrete aim is to get dividends. And of course, in this way, they're interested in getting the financial performance evaluation results about financial results from operations, and so on, and so on. So on this slide, you can see different group of interests, different group of stakeholders, the part of the interests, and the aim of the analysis. So this is the example of the possible object of analysis. And another structure of stakeholders, management owners and lenders. And another criteria. So in this slide, you can see different types of stakeholders and financial results, financial indicators that are most important for this group of stakeholders. For example, if we are talking about the lenders, creditors, for example, banks, and of course, when we are when we have negotiations with the bank, they interested in financial performance evaluation of our company, and they are making financial performance analysis based on our current financial reporting, and they're making forecast based on our business plan. They will check our forecast based on our business plan if we are negotiating with the creditor about the finance for our investment project, for example. And if we are talking about the current financial reports, they are interested in evaluation the liquidity of our company, and they're interested in the following ratios: overall liquidity ratios and different types of ratios. Then are they interested in cash flow characteristics, and of course they will evaluate our financial gearing and different types of debt ratios, debt capitalization, and so on. And if we are talking about other stakeholders, top management as a stakeholder, everything is depending on the key performance indicator for these top managers. And they can be interested in operating efficiency, and in this way they will control profitability, they will control operating costs and the structure of the costs, and they can be interested in the resource management, and in this way, in this part of management, they can be interested in controlling this asset turnover, working capital turnover, and so on. And next slide is dedicated to the role of the performance analysis. So let's talk about the role of the performance analysis and its place in the management framework. And you can see that performance analysis is the part of financial and managerial accounting, and we use performance analysis in different business processes when we are dealing with financial and managerial accounting for different types of analysis, and we use the result of the analysis in decision making. And in the process of management decision making, we can deal with performance analysis techniques in planning and forecasting in order to control, and we have discussed this form of using the performance analysis, for example, in the process of budgeting. We use the budgeting for planning and forecasting, and in order to control our actuals. And our main purpose or important purpose or strategic aim is creation of value added in different forms, in different spheres, in production, in selling, and investing. And today, at the end of our lecture, we will watch an interesting part of the video from Gary Cooking. And in this part of the video, he's discussing about the different types of value creation, shareholder value creation and customer value creation. So it's very interesting and discussive topic. So please pay attention to this part of our lecture. And regarding the techniques and methods, so we use financial performance evaluation, different spheres and different purposes for in different situations. But techniques and methods that we use for financial performance evaluation stay the same. We use vertical and horizontal analysis. We use financial ratio methods, so we use different types of ratios. And we can classify these types of ratios. We can identify liquidity ratios, profitability ratios, solvency, asset use efficiency, investment ratios. Then the other techniques, the other type of techniques and methods, trend analysis, factor analysis, comparative analysis, predicative models or forecasting models. So these types of techniques and methods we can use for different purposes in order to analyze our current position of our enterprise, and in order to evaluate our future performance for different purposes. For example, if we are talking about the investment project. Then the principle, one of the important principle of application of different techniques, we should compare financial indicators that we use for our financial performance analysis, for financial performance evaluation. So we can compare financial indicators that we use for analysis with the ideal level, so-called rule of thumb measures. Then we could compare these financial indicators to previous periods, and we can use some average indicators from the industry. If we have these figures, if we have this data, so we can use it. And in our analysis, in our work connected with the financial performance evaluation, we use financial statement data, economic data, market data, information about our company from different sources, from open sources. We can use also, for example, appraisal reports, auditors reports. We can use documents from, for example, tax committee, and so on. And the final aim, of financial performance evaluation is to understand the financial status of our company, And if we are talking about the owners, the top managers, of course, they're interested in getting the answer um, mm, the questions about the financial status, of course, and the main question that our stakeholders are interested in, if our enterprise is creating value, if we can talk about the shareholder value creation or not. And our next topic for discussion is connected with the corporate value creation and how to measure it, how to measure shareholder value. And regarding this question, we will discuss what should be the goal of management. We will try to compare accounting profit and economic profit, connecting with this question. I present you some indicators that we can use for shareholder value measurement, residual income, economic value added, market value added, and we will discuss other measures of value creation. So let's start our discussion. Value creation is important question in financial management. And in financial management, the value creation is considered to be the main objective of enterprises, of organizations. And there is a discussion in financial management as a science. Some authors, some experts state that organization or enterprise must create value for its owners only, or shareholders. But there is another point of view, and another point of view is about the stakeholder creation, the stakeholder value creation. So value must be created not just for shareholders, but for stakeholders. And there is a stakeholder theory. There is a stakeholder theory, and according to this theory, stakeholders are all individuals, group of individuals that have an impact on our enterprise, on the organization. And these groups are impacted by the activities of our company, of our organization. Using chart, can you give me some examples of stakeholders? So could you give me some examples of stakeholders? So shareholders, as we know this term, we use this term in our studying, in our professional life, and stakeholders. Could you give me some examples of stakeholders? For example, if we are talking about our famous Russian company, Gazprom or Gazpromneft, what about the stakeholders of these companies? You can write me in the chat. You can write me in the chat. What do you think about? The stakeholders of these all these famous Russian companies. Government, for example, because government is interested in taxes. Then publicity. So we as customers of some services of these companies. Then government, managers, employees, owners. Okay, thank you. So this is the definition of stakeholders. So stakeholder is any group or individual who affect or is affected by organization activities. And today we will be focused on the maximizing shareholder value, and we will discuss how could we measure the shareholder value. And in the end of our class, watching the video, working in your group, you will discuss the topic connected with the shareholder value creation and customer value creation. So customer or stakeholder value creation. So why we are talking about the managerial problem of maximizing shareholder value, of measuring the shareholder value, because there are some approaches to assess the shareholder value, but it's difficult to talk about the concrete approach of measuring the stakeholder value. That's why now it is a discussive topic, a modern discussive topic, how to measure the stakeholder value. But despite of these difficulties, it's a modern trend to discuss how our business can create the stakeholder value. And the second one, it's difficult to see how managers can create shareholder value without taking care of the company's stakeholders. So the discussive topic that in the long term, managers can only create shareholder value by creating stakeholder value. So these values are connected with each other. And today we will discuss and we will talk about the measurement of shareholder value, and we'll try to discuss what we are going to do and what we can do with the term of stakeholder value or customer value creation. So in financial management, the important hypothesis or thesis, there is the goal of managers connecting with maximizing the shareholder value. And this working hypothesis is connected with the idea that the managers who invest in projects with positive net present value create value for shareholders. And there are a lot of approaches to the value term. So beginning with Adam Smith, we know his approach to the value. Then Michael Porter defines value. And you can see on my slide his definition. And another term, another definition for value is about the capacity of a good, service, or an activity or activities of an organization to satisfy a need or provide a benefit to a person or legal entity. And if we are talking about the value creation, we can talk about the value creation in different business processes and in different forms. So in financial, non-financial, and form of time, for example. And there is there is difference in accounting and financial approach to the value creation. And based on the simple case, we will try to understand what's the difference between the financial and accounting approach to the term of value and to the different measurement of the value. And our case is the following. Consider a company with 100 million in capital, 50 million of debt, and 50 million of equity. Its cost of debt is 8%, its cost of equity 12%, and the corporate tax rate 35%. And we know that its earnings before interest and taxes are 10 million. Can we say that this company is profitable? To define and to answer this question, let's calculate some indicators. And we can calculate net income and net operational profit after tax. In order to calculate these financial indicators, let's recall how to calculate net income. On the right side on this slide, you can see the scheme of a net income calculation. And at the bottom of my slide, you can see how could we calculate the norm part, so net operational profit after tax. And on the left side on my slide, you can see the main figures of our case. And let's try to calculate together net income using this scheme and net operational profit after tax. So please calculate. Let's try to calculate. And you can write me your answers in the chat. And then we will check together your answers, and I can show you, I will show you the answers, and we will discuss the interpretation of these indicators in terms of profits in terms of accounting and economic profit. So please, I give you 3 minutes in order you could try to calculate these indicators. And you can, please, you can write me in the chat your ideas about the net income and the net operational profit after tax. So if you have any results, you can write me in the chat and we will check. So I've opened my results, so net income and net operational profit after tax, and the scheme of getting these results. And you can see the net income 3.9 and the net operating profit after tax 6.5. And what we are going to do with these figures, we should answer the question if our company is profitable or not. So from the accounting point of view, the net income and net operational profit after tax is positive. So from the accounting point of view, yes, our company is profitable. But the question is about the shareholder value. The question is about the shareholder value and shareholder value creation. Does it make enough profit to appropriate compensate its shareholders? And if we are talking about the shareholder value creation, we should take into account the rate of return that our shareholders are interested in. And we know that according to our case, shareholders require 12% return on 50 million of invested equity. So our company needs to make at least 6 million. So we can get this figure by multiplying 12 by 50 million. And shareholders require this 12% return. And it means that to satisfy the return required by shareholders, we need to make at least 6 million. It means that we need 2.1 million, and now our company is being 2.1 million short of the target. So our company is not profitable from an economic point of view. And that's the difference. That's the difference in approach of accounting approach and financial economic approach to the calculating of accounting and economic profits. Regarding net operational profit after tax, we are getting the result 6.5 million. And from the accounting point of view, our company is profitable. But the question is our company creating the shareholder value? And does it make enough profit to appropriately compensate its capital providers, investors or shareholders? And looking at this, looking at the figure, looking at my slide, we can calculate the cost of capital using the formula of weighted average cost of capital. And using this formula for weighted average cost of capital, we can get 8.6% cost of a capital. So if we recall that our capital invested equals 1,000 million, 100 million, we can calculate that our company should make at least 8.6 million. And we have net operational profit after tax equals to 6.5 million. So our company is being 2.1 million short. So that's the difference between 8.6 and 6.5 million. And we are being 2.1 million short of this amount. So our company is not profitable from an economic point of view. So our company is not creating value for shareholders. So you can see the conclusions of our case. The company is profitable from an accounting point of view, but the company is not profitable from economic point of view, and the company didn't create shareholder value. We can use some indicators for measuring the shareholder value creation. We can use the following indicators: residual income, economic value added, market value added, and some other indicators. And today I'm going to comment briefly the main indicators such as residual income, economic value added, market value added. Residual income, sometimes we can call it, and we can read in some literature that residual income called economic profit. And it's, the difference can be defined, this indicator can be defined as a difference between net income and equity that multiplies by cost of equity. And the main idea of this equation, what is left for shareholders after they have been appropriately compensated for providing the company with equity capital. So another way of calculating the residual income is the following. We can use the net operational profit after tax, then capital, the sum of debt and equity, measured by book value, and then cost of capital. And the main idea of this second equation, what is left for shareholders after they have been appropriately compensated, providing the company with capital. And the third one, it is the same equation, but in another format. So the third equation expresses the same idea in different way. And the main idea of the equation number 3, if the company managed to invest capital in activities that generate return higher than the cost of capital, then it will create the economic profit. That's why we should calculate the difference between the return on capital and the cost of capital. And if this difference between the return of capital and the cost of capital is positive, so we can conclude that we will create economic profit, or we will create the shareholder value. And main conclusion. So we should use specific measurement in order to define if our company is profitable from economic point of view. So one of financial indicator for calculating the economic profit or shareholder value is residual income, another economic value added. So the main principle of economic value added is to calculate the difference between the net operating profit after tax and the cost of capital. The cost of capital can be calculated by multiplying capital by cost of capital. So it looks like residual income. Economic value added as a financial indicator was developed by consulting company. So this method of calculating this economic value added financial indicator is developed by the consulting company in 1980. So it is a variation. So it is an alternative method. It is a variation of residual income. In order to calculate the economic value added, we have to use the special methodology developed by Stan Stewart. And in order to use these methods properly, we can take into account some adjustments. These adjustments is connected with R&D, accounting, and some expenses accounting. And next one is market value added. Market value added, the main principle of this financial indicator is to calculate the difference between the market value of capital and the book value of capital. So it looks like economic value added, but has some specific traits. And we have other measures of value creation. Briefly, let's look at several slides briefly. Cash flow, return on investments. This financial indicator is also developed by consulting company. It is internal rate of return of inflation adjusted cash flow. Then cash value added. It looks like economic value added because it's also connected with the economic profit calculation. Then total shareholder return. It is another measure of value creation. It is the sum for stock's capital gain or loss and dividend yield in any given period. These measures, we can use these measures in analysis of shareholder value creation. And you can see that there are some indicators for measurement of shareholder value creation. And there is a discussion how to calculate and how to measure the stakeholder value creation. So there is no concrete approach for stakeholder value creation. That's why we continue uh, discussion. We continue discussion. Discussion is continuing nowadays, and the next part of our the next part of our lecture will be connected with this discussion: customer value creation and shareholder value creation. What is the difference of shareholder value and customer value? How could we measure the shareholder value and customer value? What is the main idea of the customer value? And your goal is to listen to Gary Cooking's speech about the shareholder value and customer value creation, starting at 30 minutes, approximately 30 minutes till 36 minutes. So approximately 6 minutes video. And then based on this video, based on our lecture materials, please answer the following questions. What is the main idea of the shift between the shift from being product-centric to customer-centric? So what's the difference between being product-centric and customer-centric? Then what kind of gap does exist between the accounting function and marketing and sales function in terms of customer-centric strategy? And next question is connected with the following: what does it mean to connect the shareholder value creation and customer value creation? And I want you to work in groups. I will create the groups in the Zoom using the session rooms automatically. So in order not to spend the time, I will make the automatically I'll make session rooms automatically, and please work in these automatically created groups. You can use this slide, and I can send this task in the chat, or you can use LMS, because I've placed this task in LMS, and you can find this file and this presentation and the feedback file with the task in LMS. So rest. Can we work? Sorry. Yes, of course, you can work with your own groups, but in the Zoom, I can create groups using the automatic options. So I have created session rooms, and then I'll send you in the chat your task. So I have sent this task in the chat. Now I'm going to open the session rooms, and you can use your own groups, or you can use my session rooms and created session groups. And please, you can watch the video separately, and I'm going to turn on the video on my computer now. And then please attach your works in LMS. I'm going to create a special project in LMS, and please attach your files in LMS as project 1 for groups.
Items with positive items, so they couple them together. Also, quite frankly, cost accounting does not do a good job on product life cycles. It does period costing, January, February, but it doesn't focus it on a single product. So if you have a new product that's just been released, it may not have sales volume and it's a shakeout period with extra expense. But each time you take the snapshot, it would basically start migrating to the positive side. But at least it's fact-based data. At least it's fact-based data. Because remember this, especially for you younger people, in the absence of facts, anybody's opinion is a good one. Good one. And usually the biggest opinion wins, which is the opinion of your boss or the boss of your boss. So to the degree they are making decisions on gut feel or intuition or flawed and misleading data, your organization's at risk. Let's move on. Strategy, the fifth force. The move from being product-centric to customer-centric. As an example, you go to the 5 banks up in Toronto, major banks, the way Canada's organized, they've all shifted from product managers, deposits, automobile loans, to customer managers, customer-centric, because a customer could buy any of those products. And as I mentioned earlier, customers are viewing suppliers as commodities, so we really need to basically be thinking differently. The only value a company will ever create is the value that comes from its customers, the current customers and the new customers acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, serve them more efficiently, and acquire relatively more profitable customers like your existing profitable customers. But we have a couple of problems. Most organizations don't know what the profitability of a customer is. They stop at the product line, so they don't even know how to basically make the comparison. We have another problem. Sales and marketing people pretty much have 2 goals: grow market share and grow sales. But when we saw that profit cliff, we need to have them grow profitable sales. The problem is there's a big wide gap between the CFO and the marketing and sales people. There's also a gap between operations, but the operations people are doing pretty well. They have lean management, Six Sigma, and other these process improvement tools. The real issue here is strategy. And so somehow we have to close this gap between the finance and accounting function and sales and marketing. Products and standard service lines are not the only thing which accountants should compute costs for. What about all the costs that have nothing to do with making products and delivering standard service lines? The problem with traditional accounting's product gross profit margin reporting is you don't see the bottom half of the picture. And I'm making a case that this bottom half is more important. The top half is sales minus product-related costs, draw the line, product gross profit. Below that line, selling, distribution, marketing, customer service, that is much more important, and there's no visibility to it by customer. It's just a line item in the P&L. Visually, what I'm saying is if the entire rectangle here is the entire expenses of an organization, the accountants are primarily only calculating the cost for the material, labor, and overhead. But what about when we bring in distribution, sales, and marketing? And G&A, I'm saying that's much more important, and it's important for a whole bunch of reasons. I mean, one, the internet is shifting power irreversibly from sellers to buyers. And I just don't mean you all shopping on the internet. Today, a purchasing agent in a corporation with a click of a mouse can see 50 suppliers. And in my day, because I'm an old guy, we couldn't do that. We have to phone up 3 vendors to get comparable prices. This is the next problem, angel customers and demon customers. See, the issue is this. In any organization, you have high maintenance customers and low maintenance customers. High maintenance customers, always shifting schedule, never buying standards, it's always got to be special, always returning goods, always calling help desk. Low maintenance customers, you love them. Only buy standard, never shift schedule, never call help desk, never return goods. If those two types of customers bought same volume, same mix, same price, they're not equally profitable because the high maintenance one causes you a lot of work. So what this means is highest sales customers are not automatically the most profitable. But what caught my attention about this book, which was written by marketing people, is the subtitle, Discover Which Type of Customer is Which and Turbocharge Your Stock Price. And this is important because what this means is we need to really start connecting customer value creation with shareholder wealth creation. And a lot of salespeople, quite frankly, aren't really clued in. I mean, they'll do price discounts and provide a lot of different services, anything to basically make a sale, which can jeopardize the shareholder wealth creation. So with ABC, you can basically create a profit and loss statement for each individual customer, and the margins are going to be layered like an onion skin because all of those activity drivers, those little pipes that I was showing you in that multi-stage network. And in this fictitious example, if you can see, there was a 30% composite profit margin on products, but between the 30 and the 8, 22 more points of profit margin are eroded, nothing to do with product, all basically channel and customer service. And if you calculate this for every single customer, you can put them as intersections on a grid where the vertical axis is the margin on the mix, which is the above the line, and the horizontal axis is those angels to the left and the devils to the right. And now things are obvious. the most unprofitable customers are in the lower right because they're buying a low margin mix from you for whatever reason and they're high maintenance. The most profitable customers are in the upper left. And now the name of the game is move the dots from the right to the left. Mahmoud, basically, to talk about that, you need to bring in another guest speaker because that's not my job or area. That's marketing people. Cross-selling, upselling. Golf clubs, can I sell them a golf shirt? They buy the golf shirt, can I sell them a second shirt at a discount? Unbundling, fee-based, like the banks have been doing, and now the airlines are. I hate to tell you, but I had to pay 15 extra bucks to come here to go from a middle seat to an aisle seat. That's going to be... you could raise price, but that's limited. At the extreme, at the bottom right, fire the customer, terminate the relationship altogether. We're never going to be profitable with this one. So this is the kind of information one can get. All right, budgeting. I already told you, I think the budget is such a disaster. It's so broken. I think you just abandon it altogether. The way many
Okay, so we have listened to the video, and now I'm going to create the project. And please walk in with your group so you can create your own group. I'm going to create session rooms, and you will allow to choose any room. So you can choose your room. And you can work with your group, with your team as you want. So it is a group work. If you have any questions, please write me in the chat. And you have 3 questions for this video. And based on this video, based on our materials, I will create projects now. Dear all, I've created the projects in LMS, so you can touch your files in LMS in special projects. One file from your teammates will be enough. And if you have any questions, please let me know. So you can use chat, you can use chat, or you can write me by mail, for example. 4 minutes left, and then you have the deadline today, and you have time to finish your work if you need time, so you have it. Okay, 1 minute left to the end of our class. So for the end of our class, so if you have any questions, please let me know. If there is no questions, so thank you for being here. Thank you for participation in our lecture. I will be waiting for your feedback in LMS, and then I will evaluate your answers. And I send you my feedback in my tone. And thank you for being here again, and have a good rest. Have a good weekend. Have a good weekend. See you next class.